For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, then 10 investing mistakes to avoid, rebalancing ahead of and during retirement, also the die with zero rule in retirement. My name's Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group. Good morning, Randy. How are you doing?
Doing very well, Jeff. How about you?
I'm doing fantastic now that I'm with you guys. Hey, Jake, how are you this fine September morning?
I'm doing great, Jeff. Thanks for asking.
Certainly glad to hear that, Randy and Jake, and glad our audience is doing well today. We've got another great show lined up for you. Let's start the way that we do each week, Randy and Jake, with current events. I understand that Jay Powell is getting ready to do something that he has not done in a while. Let's expand on that a little bit. What do you think he's going to do?
Well, I think for most people, they think that 25 basis points interest rate reduction is kind of baked in the cake right now. There are a few people that say, hey, it might be a little bit more. And if you look at some of the numbers, and of course, what does Jerome always say? Well, based on what the data is, we'll do that,
yes,
right? So the data is showing that the economy is contracting, that unemployment is up, labor participation is down. We don't know exactly why that is, but it is. And it may be just, again, because we're seeing people at the corporate level tighten their purse strings a little bit.
What it is too much entitlement spending.
Can you expand on that, Jake? I always love your takes on things.
If you can be at home sitting on your butt with food stamps and assistance and Medicaid, and you're quote-unquote disabled but can easily run in from your front parking spot at Walmart, and you're making $5,000 or $6,000 a month in assistance, that tends to have a negative impact on the labor force. I mean, why would you work if you don't have to?
I would agree with that. I do not understand not doing something. I recently sold my hobby car, my 72 Cougar, and now I am just completely lost because I've got nothing to do on nights and the weekends, and it's driving me crazy. And what I need probably is a second job. I don't know.
I was thinking you just need another car.
Yeah, I do need another car.
At least that's what you should tell the wife.
Yeah. Well, I've already told her Randy's theory about how many things you need. If you've got 6 bicycles, I mean, really, it's the number that you have plus one, but she's just not really going along with that at this point. But I don't understand the idle hands theory here. It's just not something that I can do. So I'm always in awe of people as well who go in and get these things. They go home and, they just got nothing to do. They're going to sit there and watch TV until the next check comes. It's just something that I can't relate to. It's something that I've never done.
Yeah, for sure. I totally get that. And I just think that I'm optimistic about what's coming. And I try to spread this wherever I go. I'm trying to encourage younger folks to be entrepreneurial in the way they think and what they look at, and to know that there is hope and that there is a bright future. But as one guy said, anything worthwhile is uphill, so you have to work for it.
Yeah, I learned that early on, too, that if you want something, you have to work for it. It's pretty much not going to be given to you. And I think these days, with the younger generation, many young people today are not learning the work ethic. And I think that is something that has served me very well in my life. And I know that it has worked for you as well, too, Randy.
I'm going to jump in here, too. I think that AI is going to exacerbate this problem a lot, where you're not going to have to work for it anymore. I think it was on Jurassic Park, and Ian Malcolm said, you stood on the shoulders of geniuses. And before you even knew what you had, you were so preoccupied with whether or not you could, you didn't stop to think if you should. And I think that definitely goes for AI. But I think that young people are going to grow up in a world where AI is ever present, and it's going to keep them from having to think. It's going to keep them from having to work. And that's going to have side effects and primary effects as well.
Yeah, and I think the mind is a muscle, and if you don't use it to think, it atrophies. And, that's what happens when you sit on the couch and watch Netflix all day. Your mind atrophies, and as your pastor said, Randy, you just get weird if you just sit on the couch after a while. You got to be doing something, and you got to be challenging your mind, challenging your body. That, I think, is the secret to a long and healthy retirement. Talking with Randy, Jake Floyd, Floyd Financial Group. Of course, our program is called Show Me the Money. Our telephone number, 417-889-7233. If you'd like to contact us here at Floyd Financial Group and get your Show Me the Money financial review. Let's continue with current events. So Jay Powell says possibly 25 basis points that we're going to get in a rate cut. Some people are saying that it could be as much as 50 basis points. What do you think about that?
Right. So I think that it is something that will be kicked around. Again, Jerome has always said he'll do it based on the data. Now, a lot of people that are looking forward and kind of extrapolating what they're seeing currently with unemployment and all those things are thinking and saying that by January, we may see rates down a full percentage point from where they are now, which is currently 4.25 to 4.5. And so with that being the case, if we get there, by January, we could see 5.5% mortgages, probably even close to 5.
Right.
And that would change things. That would enable some of these people that now have 6.5 and 6.75 interest rates to save a bunch of money. I think the average house across the country is about $400,000 is what they're saying. So if you have $400,000 mortgage, well, 1% is $4,000, 1.5% is $6,000 a year or $500 a month in payment savings. So if we see that refi, the banks will start to do good because they'll get some new refi money coming in the door for getting their takedown on the loans and that sort of thing. But we will also see, I think, that housing in general will improve. And as housing improves and people start to build more homes, and then that kind of permeates the economy and trickles all the way down. And yes, trickle-down economics is a thing.
Absolutely. I learned that a long time ago. I think it was during the 80s with President Reagan at the time. It's interesting how the housing market really affects the stock market and the economy, too. People just think of the housing market as buying and selling a house, but there are a lot of other ancillary trades that are associated with that can benefit as well, too.
Especially today. I mean, when you look at homes are getting smarter and smarter, right?
Right.
So pretty soon, it'll be like the Jetsons. We'll get up, it'll shower us, shave us, buff our face, and dress us,
Yeah.
So.
We were looking at a new home the other day. As a matter of fact, we actually agreed to buy this home. But yeah, you're right. I looked on the wall, and here was this fancy thing. I don't know what to do with it. I remember the day we just had, remember, Randy, you just had like a little round dial on your wall, and it was like gold or something.
Sure.
And you just turn it to the temperature that you wanted it to be. But yeah, this is a smart home. The lights go on and off. The temperature does all this stuff. The air's clean. And I looked down in the corner there, and they had one of these robot vacuum cleaners, so they don't have to push that around. I would imagine if I went in the garage, they'd probably have a robot lawn cutter or something. Now, they have those, don't they?
Oh, they do. I was riding my bike the other morning. I ride early in the morning, and it's dark.
Yeah.
So I'm riding around this neighborhood, and it's kind of out in the country. And so it's really dark. There's no street lights, just my light on my bike, and I see off in the distance this kind of a dim glow, right?
Yeah.
So I'm getting closer to it, and I'm kind of concerned because I don't know what it is. I get closer, and I get up there by it, and it's this robot lawnmower, and it comes right out to the edge of the road, and it turns and mows right along the edge. So
I thought about that when I was a teenager cutting the lawn, or when I was a preteen, had to cut all that lawn. But I thought maybe it was a giant lawnmower that would come down from the sky, and it would just like zip, and it would go back up, and then go to the next lawn. Anyway, so I was thinking ahead of it. But yeah, there are robot lawnmowers, there are robot vacuum cleaners. I don't know what's happening in the future as far as robots go, but I know that artificial intelligence is something to be reckoned with, absolutely. Do you use much AI in the financial planning business these days as a tool?
You have to think about, so what actually is artificial intelligence? This morning I was at a Bible study, and this guy brought up, he said, before we had social media and before we had speak into your phone and we had cell phones and all that, and before we could do Chat GPT and all that, he said, we had this thing called a typewriter.
Yeah.
And he puts a picture up. He said, just for those of you that have never seen one.
Oh, yeah. Oh, yeah.
It's an archaic device.
Yeah.
Yeah, I remember the IBM Selectric typewriters. I thought that was the coolest wave of the future. Had the little ball that used to go around there.
Oh, yeah.
That was the best. Yeah. But I've talked with other financial advisors, and, they don't rely upon artificial intelligence to do everything, but they'll use it as a tool insofar as to maybe write some sort of synopsis or whatever. They'll have AI do that.
If you're looking for a specific, maybe set set of data that you sort of know the answer to, and you're looking for it to drill down for you. I don't know that I 100% trust it. And the reason is, even this morning, and this is sad, kind of sad story, but there was a 16-year-old.
Right.
They've been investigating this, that basically ChatGPT helped him write his suicide note and said it's okay to go ahead and take his life.
I heard that.
The other thing I would say, because I think a lot of people listening to this show are probably leery of AI, so I would just say to the people here, rest assured, AI is not running our portfolios.
No.
It is not deciding what we buy and sell in any way. I spend very, very little, if any, time each week using artificial intelligence for my day-to-day work and investments.
Right.
Now, that may change as time goes forward, and I'm not afraid of change. However, I've seen ChatGPT and other chatbots put out some really stupid things. And sometimes you'll ask it to do something, and it will spit out an answer that's totally wrong. And you'll say, hey, this is wrong. It'll say, oh, you're right. I'm sorry. I was hallucinating. Here's the real answer. And you're like, wait, well, what if I depended on that first answer?
Right.
I mean, that's crazy. So I would honestly be very leery of anybody who is really using a lot of AI in their models from an investing standpoint right now, because I'm just not sure you can trust it. There's another aspect of this, though, too. In investing, generally speaking, sentiment and the way people are leaning creates the environment for the rest of the investments. Meaning, if everybody's really positive on the market and there's nobody that's negative, you're probably at the top because everybody that's going to be invested is already invested. Conversely, if everybody's super negative and nobody's positive, you're probably at the bottom because all that's left is for people to get positive and start putting money in the market. So knowing that, AI is going to create a very interesting bias where what AI thinks should happen, if that's the collective wisdom of humanity, will actually keep it from happening.
Exactly.
Again, I know that's a little bit mind-melting, but at the same time, I am not convinced that AI will be that helpful when it comes to the stock market. I think it'll be helpful in other things.
Yeah.
It could even work against you in the stock market, especially if a lot of the chatbots are feeding on the same logic problems. The collective wisdom of AI, and therefore everybody else using it, will create an artificial market sentiment that will actually be a self-fulfilling prophecy, meaning it will keep it from happening the way it thinks it's supposed to. So again, I know that's a little mind-bending, but I think I would be very careful with AI when it comes to your money, at least in the next several years here.
Yeah, I would agree with that completely. AI is going to be scouring the internet, but as we know, the internet is also a valley of misinformation. So you've got to ask it, oh, that was the wrong answer. Can you give me the right answer? And AI will say, oh, you want the right answer, the updated answer? Then it'll give you that. I use AI frequently, but for things like, okay, how do you adjust a choke on a Motorcraft 2100 carburetor, something like that. I don't use it for investments, but it is a very valuable tool insofar as that goes. Talking with Randy and Jake Floyd Financial Group. Boy, we really got off on a tangent here. We were talking about interest rates being cut, and we talked about lawnmowers and all kinds of stuff like that.
We only talk about the best stuff.
Oh, I know. It's the best stuff. I want to wrap up this segment here, and I know we're a little long on this segment. So if you're hearing our program today, we appreciate you listening to us. And if you would like to come in and sit down with Randy Jake Floyd Financial Group and get your Floyd Financial Group retirement review, a chance for you to run what you've got by Randy and Jake and see if it's as good as it could be. If it is, we'll let you know. But if it's not, we'll give you a hand so that we can make it the optimal retirement plan so that you can have a confident retirement. No cost, no obligation, no judgment. 417-889-7233. 417-889-7233. 7233. You can also find out more about us online at FloydFinancialGroup.com. Time for a break. Randy and Jake, when we come back here on Show Me the Money, we're going to be talking about 10 investing mistakes to avoid when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about avoiding 10 investing mistakes.
And today, Randy, we're tackling something really important, the mistakes that people make with their investments. Sometimes it's not about making the perfect move, but about avoiding the wrong ones. So let's walk through these 10 of the most common pitfalls. Number one, investing in a brand instead of trusting data. Can you elaborate on that?
Yeah, so there's actually a couple of different facets to this. Number one is sometimes people work for a company for a very long time and they're offered company stock, and their 401k as well as through a stock ownership program for the employees. And sometimes it's a great thing to invest there, and it's great to believe in your company and stand behind it and that sort of thing. But sometimes people get invested too heavily, especially in today's world, Jeff. I mean, I remember there's companies every day that are going out of business. And these are companies that maybe have only been around 5 or 10 years. Used to be companies got big and stayed 30, 40, 50 years. They're the Microsofts, and IBM is certainly one of those companies. And you look at ExxonMobil and a lot of these big companies. But today things happen so quickly. Like you said, you got to trust the data as to what's going on, but you also have to be sure that you don't put all of your eggs in one basket. Don't get too heavy in any one stock or investing position. Now, people always go back and say, well, I don't know, Randy. O'Reilly has knocked it out of the park, and Walmart has knocked it out of the park. And I mean, all these different companies, right? But here's the thing. When we're talking about those companies, maybe you could name 50, if you really worked at it, that have really done well long-term and have just grown astronomically. But then for every one of those, there's another 50 or 100 that didn't, right? So we always have to be careful that we're not letting our emotion guide our investing decisions, like you said, but let's look at the data.
That's right. You want to be loyal to your company, but you want to look beyond the brand, dig into the actual numbers. We hear the phrase, don't chase returns. Can you explain why not losing money might actually be the smarter focus?
The chasing returns things, that's a really interesting concept. Now, here's what we mean by that. We are always chasing how we can make more money for our clients. But chasing returns is different. So when you go out and you look at, let's say you go out and you're online and you're investigating a stock or a mutual fund or whatever, and you look at their history, 1 year, 5 years, 10 years, 30 years, whatever it is, you have to realize a couple of things. If the last year has been really great for a stock, we need to weigh in and say, okay, what are the possibilities that this stock is now overbought and overpriced? What are the possibilities of that? We also have this thing out there that we see sometimes that is market rotation or sector rotation, where a sector's been good. Maybe that's consumer staples. It's been good for a while because when economies get tough, people get scared, and what do? They run to safety. So they run to the Gillettes, the Procter & Gamble's, the Folgers coffees, and all those things that do well in any time. Versus when things are good and people are cash flush, now it's Carnival Cruise Lines and all these different things. So when we talk about chasing returns, just because the history is good doesn't always mean that the future right now is good. Now, companies come in and out of favor. Business sectors come in and out of favor all the time. So chasing returns, just looking at what's happened in the past without really getting under the hood and knowing what's going on, could be a mistake.
10 mistakes to avoid in investing. We've talked about investing in a brand instead of trusting the data, chasing returns versus not losing money. Let's move on to the next one here. Randy, some people still look for risk-free investments. What's the reality there?
So at the end of the day, there's really no such thing as risk-free. Now, people say, well, hey, I can put my money in the bank, put it in CDs, and there's no risk there. Well, actually, you have interest rate risk in many cases, especially if we look back over our shoulder. Now, since COVID and since interest rates went high in 2022 when Jerome Powell started raising interest rates in March of 22, yes, CDs have paid very well. But if you look back the last 13 years prior to that, 1%, 0.5% was common. So while you didn't have any risk to your principal, you certainly had risk against inflation and your spending power in the future. I would also tell you this, if something sounds too good to be true, I've been watching this thing, I saw something on TV where they're guaranteeing a 14% return. Don't call those people.
Yeah, sort of shocked me there a little bit. 14%?
Yeah.
Are you kidding me?
I'm just telling you, there's no way that anybody can guarantee a 14% return. And people say, well, there's risk in the market. Yes, there is. There's risk in bonds. Yes, there is. There's risk in CDs. Yes, there is. There's risk in waking up in the morning and putting your feet on the ground. There is just no such thing as completely risk-free investing. And that's why it's really important that when you get ready to retire, you sit down with somebody and you talk about risk, the risk you're willing to take, the risk that you're able to take in your situation, and come up with a plan that makes sense and something that you understand and understand why we're making the decisions we make today, and the fact that those decisions are not one and done. They are ever changing and evolving.
All right, let's move on to the next one here. Randy, did your parents or your father ever say, if so-and-so jumped off the bridge, would you do it as well, too? It's like following the crowd. A lot of people want to follow the crowd. What lesson should investors take from that little story?
let's say that something really great comes along and it looks really, really great. So I'm going to talk about one instance here, and I've talked about this on this show before. A few years back, there was a car company called Rivian.
Oh, yeah.
That came out. They had never sold a car. They had produced a prototype, and it went public. It IPO'd, and it IPO'd at like $112 a share.
Yeah.
And $112 billion with a B in valuation, and they'd never delivered a car or a vehicle. Well, that was more than Ford, GM, Chrysler, Dodge, Mopar, all that together. But anyway, all those combined didn't have that much worth. And of course, today, Rivian still makes a few vehicles, but they're worth 10% of what they opened at. So just because the crowd is going over there and dumping their money doesn't mean that you should be foolish and dump yours too.
Yeah.
You know, those Rivian trucks are $107,000.
Are you kidding?
I mean, it's basically a Ford Maverick that's electric, and it's 4 times the price.
I see him coming at me with those distinct headlights, but for every Rivian, there's probably 200 Fords out there. But I know what you're talking about. Don't follow the crowd. Don't be a sheep. If all of this herd is going over and falling off the cliff, you should probably stand back and say, should I be following that crowd? Probably not. Okay, these are 10 investing mistakes, so don't follow the crowd. Next one is not performing your own diligence research. Randy, it can feel overwhelming. Why is doing your own homework still so important?
Yeah, I think especially today in the information age, the information that we have coming at us on a daily basis can be overwhelming. And what's interesting, if people are a little bit savvy in investing and they watch a show like Squawk Box in the Morning or that Morning Joe show or whatever it is that they watch, and people will say something about bonds, or they'll say something about a stock, or they'll say something about preferred stock, or they'll talk about leveraging to buy crypto with preferred stock. I mean, a lot of that stuff really kind of goes over the head of most people, okay? And so I think it's important that they have some people that they can use as a soundboard. That's one of the things that we do here is people come in and say, hey, what about this and what about that? And we want to educate people. We want people to understand what it is we do and why we do it. So that's part of doing your own due diligence. And you can also look it up online. Again, you can't trust everything you read online, but you can read several articles about it. And then again, I would say this, if you have more questions and you want some additional confirmation with some history and some backing and some time and grade that we've had here, come and talk to us about it. We want to help people understand investing. And here's what we found is the more that we talk to people and the more open conversation we have, the more people understand, the happier the retiree is. And that's all we want is a happy, successful retiree.
Right, and I want to stress to our listeners, you can always talk to us. Call us at 417-889-7233. We're here as a resource. We're here as a friend. We'll treat you right here at Floyd Financial Group. So if you do have those questions, 417-889-7233. Let's talk about concentration risk. Randy, what is concentration risk and what's the danger there?
Yeah, we kind of talked about that early on about investing in a brand or one thing or getting too centralized on just one stock or one even market, if you will. So one of the things, one of the dangers there is it looks so good and it's been so good. Boy, it's just going to continue. But my dad used to say, you know, Randy, every dog eventually has his day, right? And you've got to be aware that diversification is your friend. Now, you don't want to be so diversified that you can't make any money. But on the other hand, you don't want to rely upon one industry or one stock. Diversification across many asset classes and sectors. Also, in some cases, it even talks about geography, where people say, well, I'd really like to be invested in Bangladesh right now or China or wherever. There's times that it's okay to be invested there. There's times that it's not. And we have to be aware of cycles in investing and where companies are, where countries are. You know, Japan, back in the late 90s, the Nikkei was 39,000 points. Then it went down to as little as about 14,000 points, hung out for nearly 40 years. And only recently has the Nikkei gotten back to new highs. Before, people were saying, hey, you know, the U.S. needs to run their market like Japan. We need to do everything just like they're doing over there. They've got it all figured out. But then they had a 40-year chasm in their stock market. So again, diversification is great, but you got to do it with your eyes wide open. You got to look at the macros. You got to look at what's going on and what the potential is for any stock or any investment. Is it multiples of where it is, or is it about seeing its growth? Does it pay a dividend? Is a dividend what you're looking for? Are you looking for growth? Many different things come into play. when you're diversifying your portfolio.
Randy, let's talk about holding on to too much cash. Some people think that lots of cash is safe. What's the downside to that, though?
So, I had a guy tell me one time, he says, Randy, I just don't feel good. And this has been 15 years ago probably now, unless I have $200,000 I can lay my hands on right now. And I said, okay. Because here's the thing. If people need that to feel good, I want them to have it to feel good. I'm not here to condemn anybody and tell them that they can't have it.
It's our job to give you the right financial advice. It is not our job to control you, to make you do something with your money. It is 100% your money. We never forget that here. There's a lot of financial advisors that definitely forget whose money it is. And when you call up and say, hey, I think I want to buy this, and they're like, no. And you're like, well, why? Well, because it takes money out of my AUM and I get paid less. I mean, that's the real answer, right? So we never forget whose money it is. We just want to help you pay as little as possible in taxes and try to help you avoid the pitfalls that you can't know exist, because you're only going to retire once if we do it the right way, right? Versus we've helped thousands of people with their retirement at this point. So we can really help avoid the potholes and that kind of thing to make the journey as smooth as it can be.
And we always say it's your money, and we intend to keep it that way. You're listening to Show Me the Money with Randy and Jake Floyd, Floyd Financial Group. We're continuing to talk about 10 investing mistakes. The next one is about not adjusting risk over time, Randy. Should investors change their risk profile as they age?
Oh, I would definitely say so. Because, number one, let's say you're 25 and you're working and you're funding your 401k, you're not depending on your 401k to live on for probably the next 40 years. So you have a really long time horizon. And we know what's going to happen is markets are going to grow. They're going to contract. They're going to grow. They're going to contract. But when you're 25, 30, 35, 45, maybe even 50, you can afford to be pretty aggressive, and you're going to have time to recover from market swings. But make no mistake, you need to adjust that from time to time. There's going to be times where you're going to have made a ton of money in the market. Depending on when you invested and how you got started, some years you might make 30% on your money. Overall, you're not going to do that every year, especially as you get a little bit older. There may be a situation where you'll want to take some of the risk, put some of that money where it's going to continue to grow. But let's not put it in a situation as you get closer and closer to retirement to where we might not have the time to gain back what we need to in order for you to retire when and how you wanted to.
Randy, financial gurus are everywhere. Why should people be careful about following them?
Well, and I shouldn't probably call this guy's name. Let's call him BG. BG was the benefactor of when bonds were king, and he became known as the bond king. Now, he's still out there, and he runs a major portion of a large company called Allianz for Investing, or basically PIMCO, the Pacific Income Management Company. And I won't say his name like I said outright, but people know who I'm talking about most likely. But anyway, he was at the right place at the right time. So his experience is much different than people that are in the last 10 or 15 years involved in the bond market.
Yeah, he started investing in bonds at the beginning of a 40-year bull market in bonds.
Right.
So his entire career, bonds made money and appreciated and paid interest.
Right.
And it was a perfect storm. That doesn't mean he knows anything, but he seems like a genius.
So everybody has their perspective. And so when I look at this thing and I look back at my history in this business, I was hanging around back in 2000 when we had the dot-com bubble. I was hanging around in between those times, and then for the financial crisis, we were hanging around for COVID. We've been hanging around for this deal. So, we've seen all kinds of ups, downs, markets sideways. If you aren't careful, you'll have somebody that just has one perspective. And that's the thing that you really want to avoid. You need somebody that has kind of got this business all over them and has been doing it for a while, and not just in one niche of the overall investment market scenario.
Randy and Jake want to wrap up this segment about 10 investing mistakes by talking about letting your portfolio ruin your life. How do people keep finances from becoming a source of stress, do you think?
Well, I think that one of the ways that we do that is probably two or threefold. We like to educate people on what we do and why we do it. And then they start to feel a little better about somebody running their business. Now, their 401ks that they've had up to this time have just been, it's a balance over there, but it's not something that you really tap into or think about. And then once you get to retirement, you go, wow, let's see, I'm not going to have that regular paycheck anymore. I got to figure out how to convert this to income. So it's really important that you understand how your income is going to be derived from your portfolio. So that's number one. Once you understand that, it won't ruin your life. You don't have to just keep watching it 17 times a day. That's what we're here to do, is watch it 17 times a day for you so that we can make the adjustments when it needs to happen. Secondly, there are those that just feel like that somehow by watching it, they have effect on it. And they really don't. We are going to help you with cause and effect as much as possible. The other thing is sometimes, and we've talked about this on here, Jeff, there's one spouse that is really all into this and maybe one that's not, right? Mm-hmm. And so we had the guy with the satellite dish back in the day when that was something that was unusual on the side of his motorhome, and his wife said she wasn't going on vacation. So I don't know if it ruined his life or not, but if it was me and my wife wasn't going with me, I'd think, you think I've done something wrong?
Yeah, there's something wrong here. Absolutely. Talking about 10 investing mistakes that people make with Randy and Jake Floyd of Floyd Financial Group. Again, our telephone number, 417-889-7233. If you'd like to get in and sit down with Randy and Jake, talk about your journey towards a confident retirement. Time to take a break, Randy and Jake. When we come back here on Show Me the Money, we're going to be talking about rebalancing ahead of and during retirement when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about rebalancing ahead of and during retirement.
And Randy, we talk a lot about balance in life, and you say that balance in your portfolio is just as important, especially when you're entering retirement. Why is rebalancing so critical at that stage?
Yeah, retirement would be easy if markets always grew and interest rates were always high, right?
It would be.
But that's just not how life works. And so when we look at rebalancing, I think it's important that people understand there is risk and then there's volatility. And those two things, while they sound like they're the same, they're up and down. Risk is Rivian. And then there's rebalancing your portfolio as things change in the market and sectors come into play and into favor and out of favor. What happens is, if we aren't careful, if we just go out and set up a set of investments, and let's say we really pick it right and those investments grow and grow and grow, there's two challenges there. Number one is if it's in a retirement account, eventually every dog has its day, and there will be a time we need to rebalance because those are not going to grow anymore, those sectors of the market. There's 11 market sectors, and they're not always in favor, all of them, right? Some of them are, some of them are not. So we have to really be always watching for that thing called sector rotation where things change. We also have to be looking at maybe even individual stocks within those sectors that have really outgrown, based on their price earnings ratio that determines their value. Have they outgrown that? So we're looking at all of these things all the time to really figure out, let's not hold on too long and go down the other side of the hill where we lose money. Let's take some of that money and reallocate it to a place that has some more growth potential. Then we have the safety side of things. Maybe we need some fixed interest accounts. Maybe we need an annuity contract that doesn't allow us to lose any money, but allows us to gain money when markets are good. Maybe we need some type of a guaranteed income to make us feel good. Because, the age-old question is, hey, would you rather have $50,000 in annual income for life, or would you rather have $1 million? Well, depending on who you are and what you think about that, there's no right answer to that. It just is what you think, right?
Right.
So all these things come together when we look at building portfolios and then how we rebalance them. It's really important that we do that to manage risk so that when things are bad, we don't lose too much money. But when things are good, we want to gain plenty so that when the times are bad, we don't have to cut our income and we can preserve our capital.
So, Randy, when do you think that people should start thinking about rebalancing their portfolio as they approach retirement?
I feel like through age 50 to 55, you need to be pretty aggressive in your portfolio. Once you probably hit 55, depending on what your retirement time frame is, if you tell me it's 65, we probably have a few more years to be pretty aggressive. But if you tell me that it's 62 and you're 55, we're going to want to be looking at that and really measuring where we are. Let's see where we are. Let's see if the income on what you've invested right now is going to be able to derive the lifestyle that you want. But probably at 55 or so, we really need to be thinking about where are we, how are we going to get there, and where are we in the market cycle? Because again, the markets always cycle, and depending on where we are, it could be a great time to get aggressive, or it could be a time to pull back a little bit before we get aggressive later.
So, Randy, what does a rebalanced portfolio actually look like, let's say, for someone who's in their 60s?
So again, depending on risk tolerance, it will vary quite a bit. But the age-old, I would say, if you're going to call it anything, the age-old retirement portfolio is probably a 60-40 balance. So basically 60 to equity, 40 to fixed income of some sort, bonds, and maybe even annuity contracts is kind of where a lot of that lives. And the reason is the fixed income, the bond income, maybe the fixed annuity income is going to give you, and even the preservation of your capital, is going to give you some downside risk mitigation while we wait for markets to recover. So again, what does it look like? It's different for everybody, but again, the age-old one is probably the 60-40 portfolio. And people need to understand that that's 60% to the equity side, stock, 40% to maybe the bond or fixed income side is what we're talking about.
Randy, let's get into specifics here a little bit. How do you rebalance within your stock holdings as you get closer to retirement?
Yeah, so that's something that Jake is very, very talented at doing. He takes the time to build many, many different portfolios. In fact, he goes over and above to make sure that as we talk to clients and we get their feelings and as we talk about it, that we have available something for everyone that is manageable. Now, let me say this. Without computers, the way we manage money would not be possible these days. In fact, the way we trade stock in general, the way the investment world works, wouldn't even be possible. But today, with the technology we have, and Schwab is pretty good to give us good technology, and then we buy some other technology on the side to help rebalance and look into the market, get into the underbelly, if you will, to look at earnings, to look at all those different things, so that he can build those portfolios that will meet everybody's criteria. And so we have a blending process. We also have a process that looks at how much overlap do we have. This is one of the things that is crazy sometimes. People come in and they feel like they're diversified and everything they have is overlapped. So we're going to use here predominantly, we're going to use ETFs. We're not going to use many mutual funds. We're going to buy individual stocks is really what's going to be in those portfolios at Schwab.
All right. So you talked about ETFs there a little bit. You've also mentioned debt securities, things like bonds or CDs. How do those play a role in rebalancing?
Yeah. So if we're looking to take a little risk off the table, a little volatility off the table, and make sure we can derive and keep some income, we may shift a little bit more back to the bond side of things. However, if we're in the situation right now where bonds are getting ready to appreciate because interest rates may go down, we want to maybe hold on to those for a little bit, realize not only the interest that we get, but the appreciation in price as we rebalance that over into stock. Because when money leaves the bond market or the debt market, many times it rolls right over into real estate or more than likely the stock market, and we're going to get an uptick there as well.
Talking with Randy Floyd, Floyd Financial Group. Again, our number 417-889-7233. If you'd like to sit down with Randy or Jake here at the firm, talk about your journey towards a confident retirement. No cost, no obligation, no judgment. We'll meet you where you are. Again, it's 417-889-7233. Of course, you can always check us out online at floydfinancialgroup.com. Okay, Randy, so we've been talking about what to do before retirement. Once someone is actually retired, how often do you think that they should be looking at rebalancing?
So through our process here, we're pretty much going to rebalance automatically for people. Because if you aren't careful, what happens is one stock will outgrow the others, or maybe one market sector will outgrow the others, and then all of a sudden you are out of balance. You have too much money parked in maybe one market sector or one stock.
The timing on that rebalance, though, is kind of a big deal, and some people like to automate that. I do not like to automate that. I like to choose if and when we pay taxes, number one, because obviously if we have gains, there's potential tax consequences. But rather than having like a set rebalancing time, I like to just do it when I feel like it makes sense. Sometimes that's once a quarter, sometimes that's longer, sometimes it's shorter. But it's really more a feel kind of a thing and working around what the market gives us when it comes to rebalancing.
Randy and Jake, let's talk about RMDs, required minimum distributions. Those RMDs that kick in at age 73, how does rebalancing fit into that equation?
Yeah, Jeff, it really doesn't affect the rebalancing, actually, of that, because we know that whatever the portfolio is and whatever the risk tolerance is for the client, yes, we're going to pull some of that money out of there. Depending on what monies they have, too, some people will use that RMD as a paycheck. Others may have pensions. They may have Social Security that covers what they need. Or they may have a brokerage account that they're paying just long-term capital gains on or something like that. Or maybe they're able to get dividend income out of their brokerage account that doesn't cost them any taxes because of where they fall within the tax brackets for the IRS. So it doesn't really affect the rebalancing there. What really is going to affect the rebalancing is, again, just how markets are according to risk tolerance for those folks and where we are in the cycle. But the RMD is one of those things that a lot of people do use as a paycheck once they get to age 73, and many times way before that. We're not saying you have to wait to age 73, and anything that you take out of your retirement account, your IRA, will count toward your RMD as well. And many times when you first take your first RMD, it's around a little less than 4% of your balance that has to come out. Many times we're drawing 4 or 5% out of retirement portfolios already anyway.
All right, Randy, let's wrap it all up here. Bottom line, what's your advice for people thinking about rebalancing as they head into retirement?
Yeah, so the rebalancing part is something that, again, when we come in and you sit down with us and we talk about your situation, and we go through our 5-step process, discovery, who are you, what's important to you, what do you want to do in retirement? We look at your risk tolerance, we look at the money you've saved, we look at your Social Security income and all those different sources. That helps us to determine how we're going to set up your initial portfolio. And then from there, the rebalancing, again, is something that you know that we do, and that helps to give you a peace of mind. And again, like I said earlier, we want to educate people. We want people to know what we're thinking. So our regular review schedule that we have helps people to stay connected. Nobody's ever surprised, and everybody kind of knows what we're thinking. And so that's really it. The open line communication, peace of mind for people. When they come in and they sit down and we talk about what's happened, where we're going, where we think we're going, we look back at history, where they've been maybe the last 90 days, 6 months since we saw them last. That's what gives people peace of mind and happiness in retirement. So they don't have to look back over their shoulder and wonder, is the axe about to fall?
Rebalancing ahead of and during retirement. That's what we're talking about with Randy and Jake Floyd here, Floyd Financial Group. Again, questions, comments, 417-889-7233. We invite you to give us a call here anytime, and you can leave your name, telephone number. Ashley will return your call, set up a time for you to sit down with Randy and Jake here at Floyd Financial Group and talk about your journey towards a confident and hopefully prosperous retirement. No cost, no obligation. 417-889-7233. Randy, Jake, time for a break. When we come back here on Show Me the Money, we'll be talking about the die with zero rule in retirement. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money. Because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about the die with zero rule.
Wow. Randy, today we're talking about this rule. It sounds a little extreme at first, but what does it actually mean, the die with zero rule?
Well, I've had a few people that came in that said to me that very thing. They said, you know what? I don't want to leave anything to my kids. They can make their own money. And I want to make sure the last check I write bounces.
Yep, last check bounces rule is probably how we talk about it most often.
That would be nice if a person could really figure out how to do that. And I guess in one light, you can make yourself zero today. You could just take a life annuity, get the maximum payment, and leave nothing to your kids. But you know what? Nobody has to go to that extreme. In fact, I would tell you that that's probably a huge mistake. Okay.
We want to have our cake and eat it too.
That's exactly right. We're boomers, for crying out loud.
Well, exactly. We're used to it. But I think that phrase does grab a lot of attention, the die with zero rule. And I think if you were to really explain it, you and I were talking about that off the air, that I could have a table or a pile of money there in front of me, 3 feet high, would not mean anything to me, that money is just a tool. It's not about being reckless or going broke. It's about recognizing that money is only valuable if it helps you or it helps your loved ones live a richer life. The idea is to stop over-saving for someday and start using your resources to create some meaningful experiences while you're still healthy enough to enjoy them.
Absolutely right. I talk about that all the time in meetings. I tell people, you know, these little bushy tail things we have running around all over the ground around here that you're out in the morning, you see them and they're picking up acorns and all that sort of thing, and they're stuffing them in the ground or in the base of a tree. They are doing what you did while you worked, but here's the thing. They are, I don't want to offend anybody,
Go ahead.
They're smart enough to figure out that they need to eat some of those nuts to stay alive, right?
Yeah. I was looking out in my back deck the other day, and I've got these big pots out there, and all I could see was a bushy tail just going up and down this pot. And it was a big old squirrel. And he or she, I don't know, can't tell a boy from a girl squirrel, but anyway, they were hiding acorns there in this pot.
Right.
They weren't really eating any, although this squirrel seemed to be rather chubby. But nevertheless, yeah, they had the right idea. They were eating some, but they were also saving it, not only for themselves, but also for their loved ones. So this is different from the traditional retirement advice where we're usually told to save, save, save. Traditional advice, I mean, it focuses on you don't want to run out of money, but as I said, money is just a tool, and some people do swing too far, don't they?
Life is full of seasons.
Right.
I've been on the planet over 6 decades, so I've seen a few seasons of life. One was when I was growing up, when I was a teenager and before I got married and had kids, and then we had kids and we raised kids, and we went through the stage of really hard building of business and doing all those things like a lot of people do, and now we're kind of in that next season of life. Many times what happens is people get this idea of saving so ingrained in them that they can't quite break out of it, because here's an interesting thing. So most people don't like to pay what? Taxes, right? So I have run into people that will start pulling money out of their retirement accounts and paying taxes on it and redepositing it into a CD. Now, when you do that, you paid taxes on money that you didn't spend, so now you have less money earning for you. And most likely, if you put it in a CD, it's probably earning less than it was when it was in the market or someplace else, right? So by continuing that saving process, you actually hurt yourself because you're spending money and paying taxes on money, or you're withdrawing money, I should say, and paying taxes on money that you're not spending. So one of the things we want to make clear to people is, yes, we want you to spend all the money that you want. It's your money. We want you to be happy. But we don't want you to make mistakes like that. It's kind of like when people come and say, well, I want to buy a new car and I want to draw out $80,000 from my retirement plan to buy this car and I want to pay cash for it. Well, number one, you're going to have to draw out $100,000 or maybe more to pay $80,000 for the car.
Right.
And you can right now get 0% financing for 72 months on the same car. So I would rather slow that down, leave my money working for me rather than put all that $100,000 after and that $80,000 after tax dollars into a depreciating asset. I want to leave as much of that money as I can where it can still make money for me. So it's just a different mindset. And listen, people are not wrong. And I got to tell you, those people never run out of money. It doesn't happen. There are some that we have to coach quite a bit to not run out of money, but those are not the folks.
Randy, let's talk about timing. Why is it so important when we spend our money?
We often talk in here, whenever you make any financial decision, there's the logical, the investment sense side, and then there's the emotion because we're humans, which is kind of what Jake was talking about earlier with the AI thing, being able to predict and do investing and that sort of thing. Until AI has a way to have emotion, it can't possibly predict what humans are going to do.
Right.
But yeah, the timing of taking your money out, what do you want to do? What's important to you? How much bike jumping am I going to do at age 90 versus the bike jumping I do in my mid-60s?
Right. I do a couple of big jumps, but that'll probably be about it.
I have a feeling you're still going to be jumping bikes, though, at 90, though, and Lisa's going to be just as unhappy as she was when you were earlier doing it.
We'll see. But the long and the short of it is spending some of that money sooner rather than later generally makes sense for most people because they're going to be able to enjoy it more. And this may sound strange, but I sometimes find that actually people are kind of looking to me to say, hey, can I have some permission to do a few things and have some fun?
I agree.
Right.
And I say, absolutely. If not now, when? Let's go get it done and let's do those things that you had thought about and dreamed about for years. And listen, we're here. We'll have your back and we'll tell you, listen, you can't continue to spend $450,000 a year.
Right.
If you want to preserve your million. There's a reasonable amount. And generally, for most people that are ready to retire, we don't have to give them a pay cut, and we can help them really get to where they can live the lifestyle they want.
Randy, let's talk about leaving an inheritance. I think that some people and listeners may feel guilty about not passing down as much as possible. Why do you think that might be the wrong way to think about it, leaving an inheritance after you're gone?
There's a lot of sides to that question. One is people need to accomplish things to feel good about themselves. And your kids need to know that they can work, that they can make it on their own, and that they can have a little bit of self-esteem based on what they do. Now, it's nothing wrong with leaving money to your kids, but I have some people that will absolutely scrimp and save because they want to leave every last cent they can to their children. And I will tell you that the vast majority of children, because we get to know the kids in here a lot of times, the beneficiaries of mom and dad's estate, we get to know them. Most of them would say, Mom, Dad, go spend your money.
Right.
We'll have our own. Now, it's nice to leave things, and we don't want to squander money. We want to be good stewards, right? But at the end of the day, you've worked 30, 40, maybe 50 years. It's time to go enjoy it a little bit.
Also, I had the idea that instead of leaving money after you're gone and your kids are in their 60s, why not begin gifting it to them, let's say that when they're in their 20s or in their 30s to a certain extent, for some very specific things like a first home. Those are some things that really we can help you with here at Floyd Financial Group. Let's be practical here. How can someone start applying the die with zero philosophy without risking their financial security?
So, Jeff, that's a loaded question, buddy. You just...
Well, I think it starts with a plan. Yeah, it's loaded like a Glock 19. I know what you mean.
It does. It starts with a plan and then monitoring that plan.
Right.
Because markets are going to be good. Markets are going to be bad. Interest rates are going to be high. Interest rates are going to be low. At some point, we may have health issues. We have to consider all of these things as we go out. And if everybody knew the exact day they would die, we could tell them when to start Social Security. We could tell them exactly how much money they could spend. If interest rates always stayed the same, we could tell them how much money they could always spend and never run out, how to get to exact zero.
Right.
But, that's just not the world that we live in. So I would say this, again, starts with a plan, like you said, and then working that plan and maintaining and monitoring those plans and those goals all the way through retirement.
Yeah, I would also say, too, at the risk of, because I think there's probably 5% of people out there that want to die with zero. And there's 95% of people that want to leave some money to their family, their friends, their kids, their dog and cat, or whatever it may be for you. So I just want to make sure it's clear that we definitely are not advocating for this die with zero policy here.
Yeah.
But if that's what you want to do, it is your money. Or sometimes, like Randy briefly mentioned, we may want to accelerate in the first 10 years, but not necessarily die with zero, meaning we can front load the income so that you can go travel and do the things that you want to do. Your idea of retirement may be that you want to travel for the next 30 years. In reality, very few people actually want to travel that much. What happens is that first year, maybe you take 4 or 5 or maybe even 6 really nice trips, and then you're going to get worn out. And then the next year, you're going to not take many trips, and you're like, I think I want to travel again. And you're going to go take 3 or 4 more really nice trips. And then that might really be the end of it for you, traveling wise. And so I think if I've learned anything over the last 18 years of being here, it's that flexibility is key. You don't know what you're going to want when you actually retire. You may think you do, but I can promise you that your retirement will not look exactly the way you think it is. Life will throw you a curveball, or your wants and needs may change. And so being able to change and massage the plan as we go through is a really important part of it.
I'm going to leave this segment here with an editorial statement. And again, this is just my opinion. We're talking about dying with zero money in retirement rule here. To me, money's just a tool. It's not the goal. Your real wealth, it's in time, health, and relationships. So plan that your money supports those, and don't be afraid to spend it on things that truly matter while you're here to enjoy them. Talking with Randy and Jake Floyd here at Floyd Financial Group. Again, if anything in our program resonates with you today, you'd like to get in and sit down and talk with Randy and Jake, 417-889-7233 is our telephone number. You can make that call right now. Leave your name and telephone number. Ashley will return your call during the week and set up that appointment for you. No cost, no obligation, no judgment. We'll meet you where you are. 417-889-7233 or online at FloydFinancialGroup.com. Well, Randy and Jake, we're out of time for this week. I'm going to thank you for your time. But most importantly, as every week, I want to thank our great listeners for joining us. So for Randy and Jake, I'm Jeff Shade. Get out there, have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.